Good morning, everyone, and welcome to the specially called meeting of the County Employees Retirement System Investment Committee. We have three items on our agenda this morning, and so we'll be covering those in order. I'd like to begin by the opening statement, and Eric, would you please read that opening
Of course.
statement?
This is a special meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If the connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Sherry, would you please take the roll?
Yes, sir. Dr. Hackbart,
Here.
Mr. Cheatham,
Here.
Mr. Fulkerson,
Here.
Mr. O'Mara,
Here.
and Mr. McGraw. Mr. McGraw? Oh, you're muted.
I apologize. Here.
Oh,
Okay.
okay, thank you.
All right, we're good. Thank you. Thank you, Sherry.
Mhm.
As I had mentioned, we have three items to consider this morning at this special called meeting. The first is a recommendation by Wilshire of a private equity investment recommendation, basically focusing on as a strategy, as part of their pacing strategy that they're recommending to us. As I understand, this is a recommendation of Wilshire and does not include a recommendation from our staff. Is that correct?
That's correct from staff's perspective. We do have a couple of observations that we can provide after Wilshire presents, but that's correct. We have not had an opportunity to perform our required level of research or due diligence to really make a formal recommendation, but we have reviewed both the Wilshire material and have made a couple of observations that we can provide at the end.
Good. Appreciate that, because I guess it was a question has arisen if had not make a recommendation, but you will have comments. That's good. And the recommendation basically is a $90 million commitment to Meridian Fund number 2, and I'd like to turn it over to Wilshire to make their presentation and discuss why they're recommending that portfolio adjustment to us. Please.
Thank you, Dr. Hackbert. We have John Patterson on the line with us today. And following the approval of the pacing strategy that we had at the last board meeting, we were asked to bring our best thoughts to the table. This is one of our highest conviction buyout strategies that we've had all year. And with that, I will turn it over to John Patterson.
Sure. Thanks, Chris. And thanks, Sherry. We included in here this memo that gives you a little bit of background on our diligence on this strategy, as well as why we think it's an appropriate fit for the program. But maybe just jumping down a little further into the presentation to, I think it's slide 2 of our materials. Yes, thank you. Just maybe a little bit of background. Chris touched on it a bit, but back in February, we presented to you all portfolio pacing and construction analysis that we do for all of our clients on an annual basis. This is really just a analysis that helps you identify where you're at compared to your target asset allocation targets. And it helps you identify sort of a roadmap for getting to those targets without overshooting your asset allocation target. And so as a part of that, we've identified Capital Meridian Fund 2 as a potential commitment in private equity, and we're going to go over that today. That's our agenda for today. But then in future meetings, we'll continue to bring you our best ideas, and continue to revisit pacing and construction in future meetings as well. So jumping down just maybe 2 slides to the high level implementation. This was, again, the roadmap that we outlined that allows you to hit your private equity target allocation in coming years. Again, it's not going to happen overnight. These types of strategies get drawn down over time. So when you make a commitment for 90 million, it doesn't just get drawn down today or tomorrow or whenever you make the investment. It'll get drawn down in 3 to 4 years, and then will get realized or distributed back to you in the subsequent 4 to 8 years. And so this is just a roadmap for us to pace out a way to get to your portfolio construction targets, or excuse me, your asset allocation targets. We outlined here that first line, that Capital Meridian Fund 2 would be an appropriate fit for a North American buyout commitment, which is part of the roadmap that we outlined. So we just wanted to give you a little bit of that background moving forward. So with that, I will jump down into the actual strategy itself. If you could go to the slide that has our Capital Meridian overview. One slide down. Thank you very much. Great. Yeah. So, excuse me. Capital Meridian is a firm that was a private equity firm that was founded by Brooke Coburn and Adam Palmer. These two individuals were senior investment personnel at a well-known private equity firm called the Carlyle Group, which is based in Washington, D.C. Brooke Coburn specifically was a member of the firm-wide investment committee at Carlyle upon the time of his departure. So very senior individuals at a very well-respected and well-known private equity shop. Brooke and Adam, together with Mike Gazicki, who is one of the other investment partners that joined Capital Meridian, together they invested close to $7 billion in over 60 deals at Carlyle. They do not have what we call formal attribution, which means the CFO at Carlyle did not sign off and say, yes, Adam, Brooke, Mike, we're all responsible for this track record that they are stating. That very rarely happens in private equity. But we did a lot of referencing around the track record that they stated, and we believe that it is exhaustive and indicative of what they did at Carlyle. We spoke to a number of individuals at Carlyle who confirmed their pre-fund track record at Carlyle. So we think this is a very strong group. They reference Willie very well. They have strong networks in their target markets, and we think they have a great pedigree from their former firm. The investment strategy that Capital Meridian is going to deploy is that they're going to really target aerospace and defense, government tech, and government services investments in middle market businesses in North America. That means businesses that have roughly 10 to 75 million in profitability, and those will be equity checks from the fund that they operate of roughly 50 to 200 million. The firm is really going to focus on national security investment, state and local government efficiencies, commercial aviation, as well as federal civilian agency investment as well. These are markets and sectors in markets that we really like, just given the complexity of the deals themselves. There are very different procurement processes. There's requirements that the government requires. There's regulatory layers, and there's security clearances that are often required that you don't see in other industries. And so we really like groups that focus specifically on this sector of the market and aren't generalists that just do some investments here as well as other investments in healthcare and industrials broadly. So we like the sector specialization that the approach that they take. From a broader macro perspective, obviously I don't need to tell anyone here about the geopolitical issues that we're seeing. We expect to see continued defense spending, not just in the U.S., but abroad. We've also seen a push towards efficiencies in the government in recent years. The businesses that they target will also, really focus on bringing efficiency to the government, both in kind of state, local, federal, as well as kind of the civilian federal agencies as well. And then we really like just the fact that they can navigate the complexities that I mentioned earlier that are required in these markets. I identified a lot of the positives for this strategy. The one thing I will note is I mentioned the reference calls that we do. We do reference calls for every strategy that we invest in. We did 8 on-sheet reference calls, as well as 5 off-sheet reference calls to former employees, former colleagues, lenders, a number of different entities that know this group. We searched high and low for a negative reference on this group of individuals, and could not find one. This is a highly regarded team that has a deep network in the sectors that they're focused on. A couple of the concerns that we outlined here is, first, their fund one is tracking nicely, but it doesn't have outsized returns at this point in time. We dug deep on the assets there. We believe that at this point in time, they're extremely conservatively marked. They've had great growth at all their portfolio companies in Fund One. They've had a 32% revenue CAGR since entry, as well as a 30% profitability CAGR in the last 3 years since entry in many of these businesses. So they've shown great growth. They've shown that they've been able to add value, and we believe this is a top tier manager. The other thing I will highlight is that this group is what we call access constrained. So in private equity, these groups are going to come out with a target that they want to raise to deploy over the next 3 to 5 years. Their target is 1.2 billion for this fund with a hard cap. It doesn't state it here, but they have a hard cap of 1.7 billion. And they have investor demand of far more than that. And so investors that are coming in that make commitments in the May and June timeframe could potentially be cut back. And what that means is if you ask for a commitment of 90 million, they may only be able to find 75 million or slightly less to give to investors because they have a number of investors that are looking to invest in this fund. Wilshire is working on your behalf to try and secure more should you decide to make a commitment here. But there is that risk that it's slightly less than what is asked. I believe I covered all the high points, but I'm happy to take any questions on our diligence or on the strategy itself, and go into more detail there. But Wilshire is recommending a $90 million commitment to Capital Meridian Fund 2 today.
As I understand it, if we were to move ahead with this recommendation, or with our portfolio composition policy, asset allocation policy, with, I believe it's 8% to this particular type of investment, this would move us in that direction, but we still wouldn't attain that allocation goal. Is that correct?
That's exactly right. If we go back to the implementation slides, we wouldn't expect to hit target for 3 to 5 years, even making commitments of 600 million a year across all of the different private equity asset classes. So this is just a $90 million commitment, which will be one step towards that goal, but it will not move you right up to that target at all. Even if it was fully allocated today, it wouldn't do that.
Right. My misunderstanding. Are there questions?
John, David, I want to thank you guys for putting this together. I like the investment number one, but as more I read and more I looked at the pacing plan, and from what I gathered, it seems like whether it's due to appreciation in other parts of our portfolio or what, in the last 6 months or so, we've dropped from 5% down to closer to 4%. So it's not really even a question of do we need to make this investment in order to catch up to the 8%. We need to be finding investments just to hold steady at this point. So I don't want to lose sight of the pacing plan itself, because I think that's having that plan in place over the next several years will give us the diversification in vintage, the diversification in geography, the diversification in industry, but I really like this particular investment at this juncture, this time period. So I just wanted to kind of get that on the record.
Steve, you said you'd have some comments to provide to the committee.
Yeah, I think we would echo a lot of what Wilshire said. They mentioned the firm and the strategy have a limited track record. This was fun too. The small team, as they mentioned, does have significant experience managing similar strategies. I think I'm not sure if it was in this doc or a different doc, but they're also expected to have a very strong alignment through GP commitments, which we do view as important for these types of funds. I think with Lyle and with John, we're very constructive on the middle market government facing business sector where this fund will invest. I think that's an attractive sector at the moment. It's less trafficked by private equity. And that's really, as John mentioned, due to the regulated nature of the industry's strict procurement policies and security clearances that are often required. And the tailwinds and going to be some favorable demand with the recent increases in budgetary spending at both the federal and state level in the areas where this fund will focus. They built a platform. Again, this is only Fund 2, so short track record, but they built a platform that leverages kind of that industry experience combined with a very strong network of operating investors that enables the firm to navigate and invest in what we view as a highly opaque, regulated, and complex business to government markets where they do invest. I think this can serve as a differentiated offering, especially in the private equity space. Some of the other things that we would note, fees and terms, I think, are average to our view is slightly less favorable relative to peers and other offerings. I would also note that we generally do not prefer funds with American waterfalls, which this one has. And some of the risks, John pointed out some, but the strategy, as we've seen with much of private equity, exits have been a struggle, and they may potentially, where they focus, may face more limited exit paths compared to what we would consider kind of conventional PE funds. And that's exactly due to the stricter regulations around ownership of government-facing enterprises, so that the exit opportunities may be a little bit more limited. There's also probably fewer strategic acquirers operating in these industries, and sometimes public markets are not a viable path. And I would note that we typically, it gives us pause, significant increase from Fund 1 to Fund 2. I think from 900 to a hard cap of 1.7 is a fairly significant increase in the fund. So, that is one area where that does cause us to do a little bigger beeping. But, I would echo much of Wilshire's thoughts here for this fund.
So, Steve, I think it was mentioned that the performance of Fund 1 was not strong. Does that concern you, or do you have an understanding as why that might be the case? It may be temporary, or
Well, as John said, it's early for a fund for that fund to really where we start to have hard numbers on what performance is going to be. I think their data indicates it's third quartile performance wise. But I think it's too early to say. I think, as they mentioned, their view is that the marks are very conservative. Again, it's all paper at this point, right? We'll see when we start to see distributions and final realizations. Is it concerning? I think some of that is real versus unreal at this point. I think Wilshire's conviction in the nature of the assets that are held there is something that probably is likely to be realized over the longer term of the portfolio. Exits, I think would you say 5 to 8 is kind of what we're looking. Let's realistically, as we've seen in the current environment, it may be an extended period. As we know, we have lots of legacy PE. Those numbers will change over time. So it's not something that rises, I think, to a level of like a red flag concern at this point.
okay, thank you. Any other questions or comments? If not, we could consider this officially. Would someone like to make a motion that we recommend this particular investment consistent with the pacing strategy?
I'll put that in the form of the motion that we recommend to full board the 90 million that's recommended by Wilshire.
Second.
Motion's been made and seconded to recommend investment of 90 million to the Meridian Fund 2. Any further discussion?
I would say typically those motions are contingent on successful contract negotiations, if you just wanted to add that.
Absolutely, absolutely, certainly.
So amended.
Any other comments or clarifications? If not, we can proceed to vote. All in favor of the recommendation to invest $90 million to Capital Meridian Funds subject to successful negotiations, please indicate by saying aye.
Aye.
Opposed? Motion carries. Thank you very much.
John, David, again, I want to thank you guys for going to bat to try to make room for us in this opportunity. We appreciate that.
Happy to do so.
Chris, didn't mean to leave you out.
No, happy to do so. Thank you very much.
The second item on our agenda this morning is a recommendation coming from the investment office, and it's a recommendation relative to Franklin Templeton All Country World U.S. portfolio. As I understand it, this transaction would involve an adjustment from the current investment with Franklin Templeton to ClearBridge. Is that, if I understand correctly? So maybe if you make the presentation, if you could clarify the relationship of Franklin Templeton to ClearBridge, which is basically a wholly owned subsidiary, as I understand. If you would include that in your presentation, I think that would be appreciated.
Yeah, I'll give a brief introduction and turn it over to Joe. So,
Okay.
Joe has provided details at the last few investment committee meetings regarding the performance struggles and kind of the rising concerns that staff has had regarding the Franklin Templeton and the management of the MSCI ACWI ex-US portfolio, which they've been managing for the system since 2014. Joe has been working diligently with the manager and with Wilshire to determine a course of action to address these issues and our concerns regarding the ongoing nature of the strategy. So I think he and Wilshire have come to a recommendation that I think achieves these objectives, and I'll turn it over to Joe and Wilshire to discuss.
Yes, appreciate your all's time. I guess, Sheriff, I think it's slide 22 in the deck, maybe, where the recommendation actually might start. There you go. But before I officially start, I guess to give a little background on the Franklin Templeton relationship, as Steve mentioned, this was a part of a basket of managers that was hired in 2014. It was not meant to be a standalone, but rather, like I said, a piece of that basket of four that were to complement one another. The idea being that individually, each one of those strategies we would hope over long term would outperform their index net of fees. But we knew that the path of performance would be choppy. And so the idea was with this basket of four that we could smooth that return path. So when one manager zigged, the other one was zagging, kind of smooth that return path. Franklin Templeton was the more aggressive growth piece of that basket. It played in a mid-cap space primarily, which was a diversifier. So again, it wasn't viewed as an independent, but more a complement to the greater portfolio. It was actually in the first few years of that basket, the one that really drove the performance. It was the standout shining star. LSV at that time was struggling. And that has done a complete 180 where LSV right now is doing very well for us, and Franklin Templeton's been struggling. And Franklin Templeton actually was, net of fees, positive performance all the way up through, since inception through the 2024 fiscal year. So really this slide of performance has happened over the last couple years. And so that's kind of where we are today. But as you can see from the recommendation, we're going to recommend the transfer of management responsibilities from the Franklin Equity Group to ClearBridge. This, as Dr. Heckbart mentioned, ClearBridge is a wholly owned by Franklin Templeton Company, but they work autonomously. They run their own book of business. There were no placement agents involved in this recommendation, nor will there be any compensated as a result of it. Sure, if you'd go to the next page. So kind of what I just mentioned, after a period of strong performance, they've experienced some significant underperformance over the last couple of years. This is in part due to some significant market headwinds, being the value tilt of the market has been incredibly strong. This last year alone, values outperformed growth by 17%. The market has been very large cap biased, and this being more of a mid cap portfolio, struggled there. Market narrowness was an issue. There were also some self-inflicted wounds from a stock selection perspective. Tracking error, individual tracking error for individual securities got high. Stop loss, I'll call it passivity. They weren't very aggressive in their stop losses. The managers, we've had tons of conversations. They've tried to make some good faith efforts to address the issues that they had the ability to do. They made a change in their healthcare analyst, which was a source of some significant stock selection underperformance. That appears to have been a positive change in that they've actually added some value from healthcare in the recent last couple of quarters. They strengthened their stop loss, meaning the rule was if an individual security underperformed its peer group by 20%, it was up for review. Now, not only is it up for review, but it's a candidate for immediate sale unless a strong argument can be made to hold it. So they were more aggressive in their stop losses. They've tried to limit tracking error to 6% for the individual security, meaning it's a concentrated portfolio. The aggregation of all those securities can outperform significantly, but the idea being that not any one security can completely derail performance of the portfolio if it had a blow up. So that's a different risk mitigation that's been put in the last year. And while we view the changes as appropriate, it really is going to take a more accommodative market to see any sustained relative performance turnaround. And we're just not sure when that's going to be. You add to that the additional challenges of they're starting to see some asset redemptions. They lost a pretty significant client about a month ago. A co-PM and two analysts took a buyout from the firm. They'll be leaving the team in June. So you add up those three things: losing some assets, losing a client, some team members starting to drop off. It becomes very concerning for us. And while the strategy could find its footing, given a better market environment, I'm not confident that it will be existing when that occurs, because we don't know when that will be the case. There's been ebbs and flows where we'll see a month or two of better performance just to see that wiped out the next month. And so at this point, we're ready just to say we recommend transition the management over to ClearBridge. Again, it's an affiliate. We think it provides an attractive solution given our current concerns, the ease of transition and the timing, meaning we believe we can shift that management responsibility over with a delegation management document where we can continue to operate under the current IMA. So that allows for a little bit quicker movement of assets. The cost of transition will be covered by ClearBridge. They're going to do that through an extension of 3 months of zero management fees, and I'll talk more about that here in a little bit. But ClearBridge has been running the non-U.S. growth strategy since 2015. They've got an experienced team. It's got a solid track record. It is still a concentrated portfolio, but to a lesser degree than the Franklin Templeton portfolio. It's a similar level of growth, so we're not giving that up. It does not have the mid-cap bias that we've been, frankly, hurt us here recently. And then it has a lower tracking error as well. Sherry, if you don't mind going to the next. Again, it's a Franklin Templeton associate. ClearBridge has been in operation for 60 plus years. They have 210 billion in assets under management, 350 employees. The team that we would be working with manages 17 billion roughly across the international growth platform with 120 clients on that platform. The investment team is made up of 4 co-PMs, 3 of which have been on the strategy since 2015. They have 2 dedicated analysts as well. Each of those 6 individuals are responsible for 2 to 3 sectors of coverage. That coverage overlaps so that every sector is covered by a minimum of 2 individuals. They also are backed up by a central research desk of about 15 sector specialists. The team tries to invest in high quality businesses with growth characteristics that are trading at a discount to the market. So things that are not being priced fully, that are not understood by the market. Quality is defined by the team as a product or a process that has a durable competitive advantage, and that the company actually has the ability to finance that growth. Strategy is a value driven approach to growth, which is a little bit different than Franklin Templeton. So there is a nod towards valuation in some of those investments, which we like. It's supported by a multi factor model. It enables consistent and systematic evaluation, helps to kind of point resources in the right directions, eliminates bias from your due diligence. The portfolio construction itself, it's kind of an equal division between quality valuation and earnings and price momentum, with the idea that you'll be left with a roster of stocks with good valuations that are quality companies that have meaningful earning surprises, hopefully to the upside. If you'll go to the next page, not only is the strategy diversified across sector and region, but also by types of growth. So they try to invest 20 to 40% of the portfolio in what they call structural growth. So these are opportunistic. They try to capitalize on the industry or company changes where maybe the duration or the magnitude of that growth is mispriced by the market. Roughly half, so 40 to 60% of the portfolio is going to be in those steady eddy, consistent compounders. It provides stability to the strategy, provides a little bit of downside risk protection, and then up to 20% is going to be in what they call emerging growth. So these are your a little bit more aggressive investments. The potential for outside returns exists there. It's very fast growing markets typically. However, the potential for failure does exist, and so that's why it's only up to 20% of the portfolio, and the positions are less than 1%, so that not any one position derails the performance. From a portfolio construction perspective, they allocate across all the sectors, plus or minus 5% of the benchmark weight. Tracking error is projected to be around 4 to 6%, with benchmark level risk. Again, concentrated portfolio to a lesser degree, so 50 to 80 holdings. Turnover is expected to be around 40 to 60% annually. So you're talking about a 2-year holding period roughly. Sell disciplines like everybody else. You sell it when it hits price target, when there's a better opportunity, when things aren't working. You see the performance there. The 1 year, obviously it's not overly exciting, down 12% on the 1 year. This is a March 31 number. However, this is a growth product being measured against a core indice there. Value has outperformed growth by 17% over this time period. So of that 11, almost 12%, about roughly 8.5% of that is due to that style bias. The other issue is they've been underweight IT, and then their investments within IT have been in the software space. Software has been thrown out the window, no matter what it is, because of the fear of AI. Some software companies probably are not going to recover; others will. It takes time to see how that's going to play out, but kind of that fear of AI has really hurt the software space, and they were overweight that, so that's part of that underperformance. But the intermediate 3 and 5 year can be explained by this 1 year. The 10-year, the since inception numbers are still solid. And really, I think maybe more importantly is the fit of this strategy within the context of this basket of managers we have. So if you, Sherry, go to the next page, this is probably more important. That top left chart is going to be your y-axis is return, and your x-axis is risk, standard deviation. And so you look at Franklin Templeton there in the blue, and you compare that to Clearbridge, which is the red, and you notice that the movement is up and to the left. And so we think that points to a higher quality portfolio. The two strategies, Clearbridge providing better performance with less risk attached to it, and the proof is in that gray box, which is our current composite with Franklin Templeton, and then the yellow box being the current composite. If you were to switch out the Franklin Templeton product with the Clearbridge product, you see a slight move up and to the left, again improving on return and bringing down risk a little bit, so pointing to a little bit higher quality portfolio overall. The bottom right chart is a kind of a style box. Your y-axis is going to be market cap. Your X is going to be value all the way on the left, all the way to growth on the right. And you see, again, Franklin Templeton, the blue dot, and ClearBridge being the red, similar levels of growth. But we eliminate the mid-cap bias, moving up into the large cap space with ClearBridge. If you'll slide to the next page, this is as of about a week ago, had about just under 550 million in the Franklin Templeton strategy. This equates to roughly 9.3% of the international mandate, 3.6 of the public equity, and 1.6 of the total portfolio. You see the dollar breakdowns per plan just below that. The C plans really are for that international equity. This is really about 9.1% of your portfolio, about 3.5% of your public equity, and it is about 1.8 of your total. It's a little bit larger on the total because you have a greater allocation to public equities than the K or the S plans. From a fee perspective, ClearBridge originally had offered a zero management fee through March 31, 27. This was consistent with the renegotiated fees that we did with Franklin Templeton earlier in the year. However, there is a cost to transition assets. And so while ClearBridge is not going to cut us a check for that, and we're not paying a check for that, that comes through commissions and through market movement. They agreed to extend that zero management fee through June of 27 to account for that cost of transition. So July 27 proposed fee would begin at 33 basis points. Anything in excess of 750 million would be at 28 basis points. This makes it the cheapest active international mandate in our portfolio at the proposed fees that they've noted there. And I guess, Sherry, one more page. Staff and consultant. So Wilshire, we've had some conversations about this. We believe the transition is a positive response given our current concerns. ClearBridge offers what's expected to be a consistent performer whose inclusion we think will improve the quality of the overall international portfolio. We expect better relative performance with lower standard deviation than we currently have from the Franklin Templeton product. We maintain the same levels of growth at lower tracking error by getting rid of that mid-cap bias. That's been a bit of a headwind for us. We think the transition of the management responsibilities to ClearBridge is attractive logistically and from an administrative standpoint. We think it can be done relatively quickly through a delegation of management document. ClearBridge is going to bear the cost of that transition through an extension of the fee discount. And again, 0% through June 30, 27. We do recognize this is a little bit different process than what we typically would do with a search. However, given our concerns with the timeline, staff and consultant believe this to be a prudent move that we do believe improves the portfolio's quality. That said, staff and consultant also view this as an opportunity to do a more deep dive and full review of our international portfolio to ensure the efficacy of both the structure and the exposures. That's not to say a year, 6 quarters, year and a half from now, we don't say, you know what, we like what we have, we've reviewed it, things are going well. It also doesn't mean we don't come back and say, actually, there's a couple changes we want to make. So we're going to use this as an opportunity to really review the entire international equity portfolio. That's all I had prepared. Happy for Wilshire. Chris worked with me on that. Jump in or answer any questions. So
Maybe, Joe, a couple questions. How long have we been with Franklin Templeton? Do you know?
Since 2014.
2014.
So they were brought on as a basket of 4, as the aggressive growth piece of that basket, and frankly, a diversifier giving us exposure to the mid-cap market that nobody else did. So it's not one that we would have hired standalone by itself because you would embed those biases in the portfolio. We didn't want to do that, but it did serve a role in that basket. And like I said, at the beginning of the relationship, it really drove the performance. And the basket as a whole has performed. It has outperformed. I looked at the most recent March 31 number. 2 of the managers of that 4 have outperformed the index pretty well. One's right in line, and then Franklin Templeton's been a little bit behind. So the basket has done its job. not to the degree we had hoped because we've had some erosion of performance over the last year or so. But it's not necessarily been a bad experience. But we do think it's time for an upgrade or a change. So,
Did you look at other opportunities besides Clearbridge?
not in this moment, other than we have. You had maybe remember me saying we have looked. We were kind of doing, I guess my term was a shadow search, where we didn't go out in the market publicly because we didn't want to signal anything to Franklin Templeton, but we have looked at some other products. We have gotten some information on them. We have compared that to Clearbridge, but we didn't do a formal search, so we're aware of other options. But frankly, the timing was a real concern that this may not be an ongoing strategy for much longer if people start running, making a run on the bank, to use that terminology. So this buys us. We think this is a solid, Clearbridge, a solid investment manager. It's a third decile ranking with Wilshire's qualitative group. And this gives us some time to do a more full dive into the entire international portfolio to make sure we're comfortable with our positioning. So,
Well, thank you, Joe, for a good, very nice presentation. Questions of Joe?
Mr. Cheatham, you're muted.
Sorry about that. So I want to tell Joe I appreciate the dive and the work that he's done on this. I think, we always have to be evaluating our managers from year to year and see how they fit. I know Franklin Templeton's been on a buying binge as far as other asset managers over the last several years. Did we look at any of the other in-house subsidiaries that they own, or did Clearbridge just automatically was at the top of that list?
I worked with someone, our relationship manager at Franklin Templeton, and they believed of their current offerings under the Franklin Templeton banner that this was the best option and the closest thing to what we were looking for. And so we put that in the context of our existing portfolio, and it fit well in that we maintained the same level of growth that we were trying to get from that piece of that basket, but we were doing so with a little bit less risk and taking out that cap bias tilt that was really hurting the overall international experience. So it fit very well. They were willing to extend and honor the 0% management fee that no one else is going to do, and to do the full search. We just didn't think there was the time, given at any moment a large redemption could cause the strategy that Franklin Templeton, we may be the one that causes it to collapse. And so we don't want to be stuck holding the bag, essentially. So we think this is a really good check a whole lot of boxes. Plus, it happens to be a fairly a solid manager that Wilshire is favorable on. Chris, feel free to comment if I'm misspeaking.
Yeah, and so from our research group, that, as Joe mentioned, this is a third decile manager, which is a highly ranked manager for our manager research team. This is somebody that we have conviction in, and if we were to kick off a search today, Clearwater would clearly be right in the middle of the conversation of some of the strategies that we would be bringing to the table. To Joe's point, there's been some turnover within the management team at Franklin Templeton, and with the most recent buyouts of some of those portfolio manager, one portfolio manager and two analysts that are going to be moving on from the firm. This is really more of a qualitative change for us, that we are probably going to be downrating their strategy to a fifth decile overall. So this is something that we do feel is warranted. It's always tricky to figure out when you terminate a particular strategy, but given the turnover in the team, we feel like this is the right time to move on.
Yeah, improved return and excuse me, less risk is always a good thing. So I'm
And the international growth space has been very challenged, as you can see from the returns, even for
Yeah.
Clearwater. I'm sorry, for Clearbridge. They are they have negative returns, but everybody in this space is really struggling because growth has just been out of favor in the international markets. So, when we look at an overall manager ranking, we certainly do take the performance into consideration. But if we were going to have an overall score for a manager, we look at 75% qualitative, 25% quantitative. So we don't try to chase the returns because active management is a, cyclical process. You're going to go with the ebbs and flows. So we really do want to find the right fit that for the portfolio and the composite. And as Joe clearly pointed out here, we are taking some of that risk off the table, and we've been able to kind of minimize some of the downside in that Franklin Templeton return pattern that we've seen by moving to Clearbridge in the composite.
Just curious, I noticed you cited Clearbridge has approximately 16 billion in this space that they manage. Franklin Templeton, how much did they have in this space?
Across their entire, sorry, go ahead, Chris.
No, go ahead, Joe.
I was going to say, I have to come back to you on the entire international growth space in the portfolio. The strategy we had, which was a concentrated version of their flagship, at one point had 6 billion in there, and since then it's now at about 3.5 billion. And so, due to performance, due to some redemptions, and the 6 billion number is from 10 years ago. So it's not like it just all of a sudden got cut in half or whatever. And so this is 16 billion is a substantial amount of money that this team's been running since 2015. They're not new to the space, and it's a meaningful part of the Clearbridge business. And so I don't have a concern from that perspective. So.
Have their assets in this space been going up or down?
They've been slowly adding. They've been stable to adding. So
I'm comfortable with making the change. I'll put that in the form of a motion, Mr. Chairman.
Thank you, Lyle. Okay, is there a second, please?
Second.
Motion's been made and seconded to accept the recommendation to take a shift from Franklin Templeton to Clearbridge. Any further discussion or clarification questions? If not, we can proceed to vote. All in favor of the motion, please indicate by saying aye.
Aye.
Opposed? Motion carries. Thank you very much.
thank you.
Thanks, Chris, and
Thank you.
Joe. Thank you very much for your presentation. It was very clear and very effective and helpful. The third item on our agenda this morning is a real return investment recommendation from the investment office. And Steve, turned over to you.
Thank you, appreciate it. One last item. Hopefully this one is a relatively quick one. So the investment committee and the board unanimously approved staff's recommendation to commit up to 200 million to the IT rail fund as part of the real return allocation, and that was in December of 2024. This commitment was fully called and deployed by October of 2025. And based on our strong existing relationship with the manager, we have an opportunity to increase our commitments that Anthony will provide detail on. I would note that, as he mentioned in the memo, it does involve a potential public transaction, so there are limits on what we can discuss. But Anthony?
Yes, thanks, Steve. If we go to page 45, please. Let's see here. Okay. Yes, this is the real return allocation today. Most of the C plans are around 6.5% versus a 7% target. I think, like Lyle mentioned, some of that might be due to market appreciation. That number is also a little bit higher because it includes the cash from Prisma, the lawsuit that's in the gray pie. If you look on the right side, there's some cash that's tied up in there, but it's still counted in real return. If you go to the next page, please. This is is what it would look like if fully called. There's still some capital to be called in our sports strategy, as well as the barge leasing strategy, the additional capital that you all approved last year. They've made one call on that, and they have some potential other deals that are going, but they also made a couple last year, which is why they made the capital call. Okay, we can go to the next page, please. As Steve said, this is a slide we showed you a couple at the approval, but we've added the funding dates there where they funded the capital. We can go to the next page after that. This memo is pretty similar to what we presented in December of 24. Again, there's potentially a public transaction that's involved here, so we're not able to say a whole lot about it, but it is in line with the strategy that they have of leasing rail cars across a wide range of industries and commodities. So if we want to go to I guess you can go to page 50, please. An additional commitment would also get us to another fee level. So there would be a lower management fee across the whole commitment, as well as a slightly lower performance fee that would occur going forward. I think this would take us to a total across KPP of 500 million commitment. So that's what that's counted against. Okay, we can go to page 55, please. So 55, you can see the lessees are quite diversified. This is different than the barge leasing strategy, which is much more concentrated. The top lessee here is a couple percent, and then everything after that's less than 2%. With commodities, similarly, the highest is 3 to 5%, and then you're not subject to the shocks or changes in any particular industry or commodity, which is, as you've seen recently with the war, can change quickly. And then I think beyond that, we're just open any questions you may have, and I think that's it.
Yeah, I'll add one comment. So, I appreciate the work on this. This is, as Anthony noted in the memo, so this is an open-ended evergreen structure fund, but it's essentially been closed to new commitments and was actually closed prior to Anthony's persistence and communicating and working with the manager actually got us the initial access back in 2024. And again, it hasn't been there's not been new commitments to the fund. They've essentially been closed since then. This is a new opportunity, and it's very limited availability. So that initial recommendation, the sizing of that initial recommendation back in 2024 was based on that available capacity. And kind of given Anthony's persistence and work with the manager and the view as we're a good partner. That's why part of the reason that we're getting offered this opportunity to increase our commitment level. And again, that's based on potential capacity increases that the fund is going to have. So happy to answer any questions.
I've just got a couple more information. I noticed you reference on, I think, slide 45, the 9% that's in cash setting with Prisma, but it's not referenced on the following slide.
Like a pro.
I'm sorry.
It's like a pro forma, like if everything was called and the lawsuit was settled and we actually deployed that cash into something that was actually a real return.
Okay, that's what I wanted to understand.
Yep.
The other one was on the area that you just covered. With regard to I was a little bit, I don't know, I guess I assumed the renewal rate would be a little bit better than 77%. Is that number tend to stay pretty steady? And I noticed on the chart below that, you got a lot of renewals coming up over the next 3 or 4 year period of time. Is that just because of the acquisitions of the other rail cars that they made, or why is it so front loaded on the renewals?
I think that's just because of the length of the leases. So it's usually around 15 to 20% of leases rolling off any given year. So, I think that given that that's 5 to 6 year leases. So I think that tends to be what you see there.
Yeah, I mean that I assume that's what this was in this,
Mhm.
this pie chart, but you know, those later years that it's quite a bit lower than what it is in the next what 4-year period of time.
Mhm.
There you go.
Yep. Yeah, I think that's, we can ask about that, but I think that it seems fairly in line with the 15 to 20% that they've indicated to us. I think obviously when pricing is better, they try to lock in for longer, but and the other way around,
Okay.
if it's, they want it to be shorter, if it's a little softer, and then they can try hopefully reprice it in a better environment. That's kind of
Yeah.
a thing that they tend to do.
And they certainly appear to be a pretty steady player. I don't have a problem with that. I would like to know why those leases seem to be front loaded.
I mean, that's something we can find out, but I think that doesn't look like outside the normal range, but we can ask about that. Yeah.
Yeah, we'll follow up with additional information on that.
Any other questions of Anthony or Steve?
Just so everybody noted, it looked like uh, you're anticipating a pretty steady, 9% rate of return. Did I see that in there somewhere, Anthony?
I wrote about 6 to 9. I think the Wilshire estimate was 10 to 12. It's just a little more conservative. But yeah,
Okay.
it's been a couple percent a quarter. It's pretty steady since a lot of the lease payments and amounts are known at the beginning of the year. But obviously, with if things get more favorable, then they're able to increase price as was kind of discussed in the lease price index. There's still some room for them to raise upon renewal. So there's a little bit of upside with that. But yeah, I think consistent with that, the fund was up 8% last year. I think we were in it for 3 quarters, so we got 6.5. So it kind of has performed as kind of we expected so far.
Does fuel cost impact our profitability here any?
That's something we can look at, but again, I think given all the commodities that are there, it's pretty diversified on who they face, and then in terms of fuel, I think like most of these businesses, they tend to pass that on if it's something significant. But again, we can find out the specifics if you'd like.
Okay.
So this recommendation would be for an additional 100 million commitment, is that correct?
That's right.
Right. And our current commitment is how much?
It is 200.
Okay, right. Okay, so about 50% increase. Okay. Any other questions of Anthony or Steve?
Does this keep our target allocation intact, or are we running behind there?
So this will get us very close to the target allocation. As Anthony mentioned, though, we have the one asset that's currently classified. I sent you guys a memo a while ago regarding potentially reclassifying that based on outlook for settlements. It's essentially sitting in cash, so it's not actually going to perform from a performance or risk standpoint like a real return. So that would be a discussion for another time. Even with that, it still gets us to right below, it's going to change day to day, but right below target.
Okay. All right. Thank you.
Would someone like to make a motion to approve this recommendation of staff?
I'll make that motion, sir.
Thank you, Lyle. I appreciate that. So is there a second, please?
Contingent on successful negotiation.
Exactly.
We'll accept that modification of your motion.
There you go.
I'll second this one also.
Thank you very much. Any further conversation, discussion, comments, questions? If not, we can proceed to vote. All in favor of the recommendation to commit an additional 100 million to this fund, please indicate by saying aye. Opposed? Motion carries. I believe that concludes our agenda for today. Thank you all for being here and a very good conversation and excellent presentations and very informative. So that will conclude our meeting today. So I don't think we need a motion to adjourn. We'll just declare our meeting adjourned. Thank you very much.
Thank you very much.
Thank you.